Hi everyone, my name is George Belleville. I'm a realtor in Maryland, and I'm creating this video for a couple reasons. One is as a refresher for people who've had a real estate transaction and it's been a while and they don't remember the paperwork. And the other is for people who've never bought a home before or for newer agents to help them understand what's called the ALTA, or the settlement statement, which is the documentation of all the funds that come into the transaction, how they're dispersed and spent, and then what's at the end for each person. So I want to go over that. This might be a little bit long, but it's good to understand everything that goes into this process and how it's documented for both parties. So I'm going to share my screen for you, go over this. So at the top of the form, it just has the date and who the parties are. Obviously, we're not going to show that. And if you notice, you'll see on one side, we have debit and credit to the seller. And on the other side, we have debit and credit to the borrower. And the easy translation of that, credit means give money to them, debit means take money away from them. So some of these are the same on both sides. Some of them are different depending on what it is. But you'll see we have deposits and credits, prorations for taxes, loan payoffs, real estate commissions, new loans, and some other things. So I'm gonna go through these and just kind of show you how they lay out. So the first thing you'll see is we have the sale price, which is over on the right is a debit to the borrower. So that's a take from them of the sale price of the house, and a credit to the seller on the left side for the sale price of the house. On the right side for the borrower, you see they're credited with the $10,000, which is what they put down as their earnest money deposit when they wrote their offer. And then you'll see a seller credit of $2,600. That's on the right side and the left side. That's because that $2,600 went from the seller to the buyer. And that was I don't remember what that was for, but the seller gave the buyer credit. Maybe it was for in lieu of some repairs or something like that. And then on the left side over here, you will see this post-occupancy security deposit. So the sellers stayed in the house for a little bit of time after closing, and they gave the buyers a security deposit in case the house was damaged during that period. If they had paid for the rent back, that would also be documented on here. But in this case, the buyers gave the seller a free period of rent back. The next thing you'll see over here on the left side for the seller is the $350 water bill escrow. Basically, what they do is the title company just holds some money that's more than enough to cover the water bill, because obviously the water bill doesn't run on the same cycle as the closing. So when the new owner gets the water bill, they just let the title company know, and then the title company pays it with this part of the funds that are held here and then gets the rest back to the seller. Pretty simple. So this next one, it can be really confusing for people. It's actually kind of simple, but until you've been through it, it can be a little bit confusing. So you'll see there's $1,298 on both sides. It's for county taxes. So in our area, taxes are paid in July and December. So most of the time when you go to closing, the seller has already paid taxes, and so they're not going to pay taxes on a house that they're no longer living in. So this closing happened, as you can see, on April 13th. So basically what this is the borrower is crediting the seller $1,298 for those days from April 13th to July 1st that the seller had already paid the taxes for. So it's the buyer paying the seller for the tax bill of the days that the seller is no longer going to live there, but has already paid. So, and then on the left-hand side, we'll see over here, we have the loan payoff for the prior owner, and then the real estate commissions, which come out of the seller's funds. And then below that a little bit, we have, let me scroll down a little bit, these are the loan costs. Let me get rid of those old check marks. So this obviously only applies to the buyer, and what you'll see is the loan amount, they're being credited because they're giving them that money. And then you'll see a bunch of fees, and these break out differently depending on the lender, but they usually charge, there's a credit report charge, they charge either an underwriting fee or an admin fee. They have different names for them, and obviously I'm not going to go into all the details, but some of them are fees that go to the lender, and they charge that fee. Others are pass-along fees for work that they have done on your behalf, checking certain things. You'll also see on here, actually near the bottom, this is another important one that kind of confuses people first. Almost forgot this one in the middle. Prepaid interest. So one thing to know when you're buying a house is that mortgages are already due on or automatically due on the first of the month. But closing doesn't always happen on the first of the month. So what this is they have you pay from whatever day closing is until the end of the month. So in this case, closing was on the 13th. So they had the buyer pay $948 up front to reset the payment. So the payment's always due on the first. So, and another thing outside the scope of this, but mortgage interest is paid in arrears. So when you pay that payment for, in this case, it says April 1st, that would be for, or May 1st, that would be for April. So since they've paid through May, they won't have a payment until July, which pays for June. So you're always paying your interest in arrears. And then below that, you'll see the homeowner's insurance premium. You have to pay your homeowner's insurance premium for the year. And then they prorate a little bit, which is they take out a little bit of your homeowner's insurance and taxes each month to put in your escrow account where that money can build up so that when the bill is due, they have the money to pay. Because guess what? The lender is never going to pay your bill with their money. So they keep a little money in there. It's a little bit more than they actually need, so they're never short, and they use that money to pay the bill. And then there's a thing here called an aggregate adjustment. When they do the calculation of the homeowner's insurance and the taxes and what they're going to hold, there's some federal guideline, and I don't honestly know what that calculation is, but they're only allowed to hold a certain amount. So after they calculate those, they put it against this aggregate limit. And in this case, the buyer was given $632 back. I'm not sure why they don't just calculate it correctly to begin with instead of giving you this money back, but that's how it's done. And beneath that, you'll see the title charges. And most of these accrue to the buyer, but some of them are to the seller. So what you'll see here is in these title charges, you'll see lender's title insurance, and this is what protects the mortgage company from issues with the title. Did the prior owner have clear title? Were there any liens, undiscovered liens? Sometimes people will do business agreements and they'll put a house up as collateral, but it's never recorded and it's found out later. There are all kinds of reasons why the lender wants you to have title insurance, because that protects them from having a mortgage out on a house where the borrower doesn't actually have clear title to the property. So that's pretty important. So, and then some of these other things are various fees and things that the title company charges. They have to get a lien certificate from the county to make sure there are no liens. They have to record some things, just a few different fees that they charge. And some of those are also over on the left charged to the seller, or not all charged to both. Some of these are only seller charges, paying off the mortgage company, some lien releases and things like that. So let me scroll down a little bit more. And then the second page, we have government recording and transfer charges. So each document is $60. So I'm sorry, or is it 30? I think it's $30. No, $60. One for the mortgage, one for the deed. So that's $60 each. And then there's what's called transfer taxes. So the county charges a transfer tax and the state charges a transfer tax. So in this case, you'll see that the contract stipulated that they were split 50-50 between the buyer and seller. But you'll see on the right-hand side, there's one that's blank. So in Maryland, if you're a first-time home buyer, the state waives their portion of the transfer tax. So it's about the only tax break you're ever going to get in Maryland. But there it is. So you can see quite clearly, everything is split evenly between the two. And that's kind of the standard way of doing things in Maryland. It's not required to do it that way, but that's kind of the default that everybody follows. And you'll see there that the buyer received a waiver of the state transfer tax because they were first-time home buyers. Then you'll see on the left over here, the prior owner, or the sellers, had purchased a warranty that covered them while the house is for sale and covers the buyer for the first year that they own the house. And also there was some money withheld because they had actually moved to another state a while back. So there was a little bit of confusion on that. But anyway, if Maryland will withhold some of the funds for if you're an out-of-state seller. And then over here we had a pest inspection fee that wasn't paid at the time of the service. It was billed here. So then the title company will just cut a check to the pest inspection company for $39. So what that gives you at the bottom for the seller, it gives you all the money in and the money out. So they're credited with the 542,000 minus the 222, gives them a net to seller of 320,000, where over here it says due to seller. And then due from borrower, it's all the expenses that they, or costs and expenses that they incurred minus the loan, and also being credited for the deposit. So what they had to bring to closing was $111,234. So one thing too, this is a lot, I know. One thing you will get from your lender, almost all of this exact information in a different format. It's called the CD. They have to disclose that to you a couple days before closing, so you have time to review it. They changed the laws 8 or 10 years ago. People were actually sitting down to closing and being presented with this document, which it's a lot. So we usually try to get it a day or two before closing. I review it, make sure it's accurate, and then we send it to you. And then I will call you, or we'll do a Zoom and we'll go over it just to make sure you understand everything. So that is the ALTA, or closing statement. I hope this has been helpful to you. If you have any questions, our contact info is down below, and have a great day.